Hello, everyone. Wishing you a very, very, very happy new year and hope this year brings you a lot of good health, success, and especially good times in investing. We've seen a fairly dramatic year in 2022 with lots of asset price changes across different asset classes. And 2023 also, as with investing, it will be interesting. There are so many things that we are not very sure of. Where will the interest rate hiking cycle in the global world and in the emerging markets, how long does it have to go? Will inflation actually come down to the levels that central banks want them to? uh, what is the outlook on how the entire Russia Ukraine situation evolves and has impact on various commodities and especially on inflation. So interesting year ahead. We'll just take a quick review of what we saw in 2022 and where we are positioned and how you should position your investments, especially as non-resident Indians, where you have a global account or a global investing horizon. How should you see your allocation? So if you look at global equities, it had a kind of a terrible year in some sense, a very large drop, of almost about 20% drop in the US markets and many other world markets. If you look at the high valued sectors like tech, or even growth stocks, or stocks which have characteristics of quality, they also fell quite a bit. As interest rates rose, the impact on growth stocks was felt across the globe. And as compared to when you look at the value style of investing, which is slightly more longer term, more sensible in terms of assuming for different aspects, different market situations, that has done well and looks like it will continue to do well. India had a decent year, Indian equities, in INR terms especially. I think India was slightly positive, but because the Indian rupee had a fairly large depreciation against the US dollar, almost 10%, Indian equities also had a negative returns in dollar terms. But as compared to other developed markets or some other emerging markets, I think India has done very well despite record selling by foreigners. This is just the strength of the Indian domestic investor. They've kept on investing either through SIPs or even through lump sum, and has absorbed the very significant selling that we saw from the foreigners. But India, even in India, it was different, right? If you look at some sectors which were the darlings of in the last 3-4 years, did have a not so very good year. A lot of what are so-called growth stocks, or stocks which are valued at a very significant premium, did see a reasonable sell-off, or what we call P, price to earnings derating. So even in India, it was although the overall markets kind of held up well, but within the marketplace there was a very big difference in terms of what did well: value, PSU, some industrials, and what did not do well. A lot of the growth, high valued stocks, or even tech for that matter. The quantum value equity strategy actually seems to be positioned very well. It had a reasonably good year in 2022. And despite markets still at record peaks in India, closer to record peaks, the quantum value team keeps seeing value in certain sectors, in certain stocks, getting new names in the portfolio, and broadly seems to be very well positioned for the ongoing economic recovery that is happening in the markets. If we come to the bond markets, again, if I look at the global bond markets, amongst the worst year on record, developed markets. In most countries, interest rates and bond yields went up by 200-300 basis points during the year, and that had the impact. So if you look at bond portfolios, or your own investments in, say, any global bond portfolio, that would have had a fairly big knock. But it's also, going forward, it's going to be good for investing, right? If you're investing in bank deposits or in money market mutual funds, or just in general bonds, the yields that you're getting are 200-300 basis points higher than what you were getting. Cash lying in your bank deposit will start earning you some returns as compared to it being zero or negative in some part of the world. So generally, cost of capital has gone up. And when that happens, you see much more sanity and sensible investing, because there is a cost or opportunity cost of leaving your money in cash, and that cash earns you certain return. Many investments get rethink, and how people allocate changes. And we believe that interest rates will remain reasonably high despite economic slowdown that we're seeing globally. I think central banks, just to regain credibility, will keep interest rates at a fairly elevated level, as what you've seen over the last 5-7 years. So cost of capital will matter. And for you also, just leaving cash in your bank deposits, be smart about it. You should try and earn whatever sensible risk adjusted return that you can earn of your cash balances. If I look at commodities, which is an aspect of inflation, it was a whirlwind year. I mean, as the Russia-Ukraine invasion took place, commodities went up. It had gone up in 2021 also, and it picked up a lot, especially energy and food prices. And by the end of the year, we've actually seen everything come down. Energy levels are, prices are, like oil and gas, are closer back to where it was pre-Ukraine, Russia. Food prices as well, metals as well. So commodities have gone up and gone up, but the impact of inflation still remains. I mean, we're still seeing the impact of the rising prices in 2020, 21, and 22. It is still feeding on inflation, and hence headline CPI inflation is reasonably high across the globe. But in all this mayhem, gold did well, right? I mean, in dollar terms, it held its price, but in other currencies, in euro, in pounds, or in the Indian rupee, it did very, very well. And just shows the strength of just having that gold as a investment, hedge or a portfolio allocation in your overall portfolio. Especially now, given the rapid demise and fall in cryptocurrencies and all kinds of crypto assets. I think it makes the case for owning gold as that hedge against global uncertainty, global risks, global central bank actions. This just makes it even more easy case for you to have gold in the portfolio in whatever currencies. Anywhere in the world you should have some gold. Like in India, gold is at near peaks in INR terms, given the INR depreciation. But it still looks to, even though it might not go up in price, but just the allocation is very, very important. Finally, if you look at asset allocation now, if you're in the developed market, the traditional, as they call 60-40 fund, 60 equity, 40 bonds, had the worst year on record, because both bonds and equities fell in prices. So that also tells you that although asset allocation is still very, very important, but there would be certain periods where you would have a situation like this, which is doesn't happen as much. Generally, when that when equities fall, bonds will actually hold their value, and vice versa. Didn't happen this year because there was a very dramatic increase in interest rates that the central bankers did. But when you see out later, as I said, given bonds are now yielding so much more better, I think that bond returns will kind of stabilize, and equity returns, depending on how the economic outlook takes on in terms of what happens to the US. Will they actually go into a deep recession? That will determine equity. But as I said, because of the cost of capital being high, the bar for equities is that much more higher. That's not the case in India, because in India, interest rates were only normalized. So 6.5% on bank FDs or 7% on bank FDs is fairly normal. That's the average interest rate that an Indian investor or Indian corporate faces. So it's not such a big difference as compared to developed world, where rates move from 0 to 3, 4, 5%. If you look at in India, there was a big allocation towards international equities, which did well 17, 18, 19, but hasn't been doing as well over the last 2-3 years. And that also, again, tells you that even when you have a global allocation, that global allocation also has to be diversified. You need to make a diversified allocation to be able to balance the different market movements and have a sensible risk-adjusted steady return. That is what we at Quantum keep focusing that. What at the end, what the investor needs is less sensible returns subject to whatever risk ability that they have. And when you make allocations like that, you will have a better sleep, and you won't get hassled by what's happening in the markets, because that's not you're investing to be able to secure and save and grow your wealth, as compared to your daily job could be something completely different. So looking forward to 2023, and I'll keep updating you depending on what we see in the markets, and what trends we see, and what strategies you should think of as investors every month. So thank you so much.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.